Welcome back to the Deep Dive. If you spent any time looking at the news this past week, you've probably felt, well, a bit of a disconnect. You have the news screaming political chaos, a fresh U.S. federal government shutdown, first looming, then actually starting.
Front page stuff.
But then on the other hand, if you happen to check your brokerage account, you likely saw U.S. stock markets setting brand new, magnificent record highs. Why is the market shrugging off political noise that, well, you'd think should be causing a pretty significant retreat?
Let's start there.
Okay, so let's unpack the political event first. The U.S. federal government officially shut down on Wednesday. And the sources, they confirm the immediate and very tangible impact. We're expecting up to 750,000 government employees to be furloughed.
Right. That's a massive number. Puts huge stress on federal services and, well, obviously on those households too.
It is a huge operational disruption, definitely.
Yeah.
But critically, the market immediately seemed to reach for historical context, didn't it?
It did. Bank of America data reminds us, the past 20 government shutdowns average only about 8 days. So the market is effectively betting on a quick resolution, kind of minimizing the long-term hit to GDP in its mind.
I see the historical precedent, yeah. But
Sure.
Is the market being maybe a bit too complacent this time? Our sources noted the political rhetoric is particularly antagonistic.
That's a key point.
We're hearing some pretty controversial statements from influential figures about possibly laying off or even firing furloughed employees. That seems to take it beyond just a routine budget fight.
It absolutely does, and the congressional impasse feels deeper this time. This shutdown really carries the risk of lasting much, much longer than those previous 8-day averages. And what's fascinating here, or maybe concerning, is that high-level figures aren't even really hiding the strategic nature of this. House Speaker Mike Johnson implied the shutdown is actually a strategy, giving Republicans an opening to, and I'm quoting here, do some things that we would not otherwise be able to do.
Because they wouldn't get Democrat votes for them.
Exactly.
Yeah.
So for some key players, this isn't a bug. It's almost like a feature, a political tool.
That framing makes sense politically, I suppose, but wow, it creates a massive structural problem for the Federal Reserve, doesn't it? When the government shuts down, all that critical economic data collection just stops. For instance, the official Bureau of Labor Statistics, the BLS, jobs report, it just won't be available during the shutdown.
Exactly right. And this raises a really crucial question about visibility. The Federal Reserve's rate-setting committee, the FOMC, they're already walking this razor-thin tightrope, losing access to the core employment data. I mean, that's arguably the biggest indicator they rely on. It forces them to essentially fly blind.
It just creates unnecessary peril for them. As one of our sources, The Economist, put it quite well. At a time when the outlook for the American economy overall is murky, and the Federal Reserve's interest rate decisions have been unusually contentious, leaving policymakers to grope in the dark is hardly ideal.
Grope in the dark, that sums it up.
And that lack of official government data suddenly makes every other private report that much more important, right?
Hugely important. Yet, despite this, looming political chaos and the Fed having to grope, as The Economist said, the main story in the markets is still buoyancy. U.S. stocks actually had a great week. They seemingly ignored the political noise entirely.
And as you mentioned earlier, there is historic precedent for this. LPL Financial's chief technical strategist, Adam Turnquist, he pointed out that investors have sort of learned to look past these budget disruptions over the years.
They focus elsewhere.
Right, focusing instead on, long-term corporate earnings, macro trends, other kind of foundational factors.
And the history backs it up pretty clearly. The S&P 500 has had positive performance during every single government shutdown since 1995. Every one.
Wow.
So this time was no exception in that sense, but I think the composition of that performance tells a more nuanced story about where investors are actually putting their conviction right now.
Okay, let's detail those numbers because they were pretty impressive for the week of September 29th through October 6th. The broad indexes were certainly strong. Large cap stocks added 1.2%, and the tech-heavy NASDAQ, that was up 1.6%.
Solid gains.
But the real strength, maybe surprisingly, was in the riskier segments. Small cap stocks were the strongest performers overall, up 2.1%.
Yeah, risk on.
And both growth stocks and value stocks were positive too, up 1.4% and 0.9% respectively. And the records kept falling.
That's right. Nearly all those segments closed at record highs today. Growth stocks missed their record close by only 4 basis points. I mean, that's basically nothing. Essentially a record, too.
So that's the stock market celebrating, clearly. But what about the fixed income market? That usually reflects maybe longer-term fear or inflation expectations, or bonds celebrating, too.
Well, bonds were not celebrating, no. Fixed income was actually slightly down for the week. The yield on the benchmark 10-year Treasury note, it rose by about 2.1 basis points, closing at 4.16%.
Okay, so yields up slightly. We're into the economic indicators that were actually available last week, because they paint a much, well, murkier picture than those S&P 500 highs might suggest.
They really do. This is where the narrative starts to get a bit more complicated.
Because the official BLS jobs report is offline, right? So analysts immediately turn to the private data sources.
Exactly. And we got the ADP employment change. That's the big private payroll report. And it really signaled weakness. It came in at negative 32,000 jobs.
Negative 32K. Wow. Compared to what was expected.
Well, economists expected a gain of 51,000. So that's a really sharp negative contrast, a big miss.
That is a significant miss.
Yeah.
And we also saw some softness in the broader business and consumer surveys last week, too.
We did. Consumer confidence, measured by the Conference Board, that came in weaker than expected at 94.2. The expectation was 96.0.
Okay, a bit softer. And business side.
On the business side, our major manufacturing survey, the ISM, was only slightly above expectations at 49.1%.
Yeah.
And maybe even worse, the forward-looking component, new orders, that actually dropped back below the critical 50% line.
Ooh, not good.
No, that suggests manufacturing activity is actually likely to contract further in the coming months. It's a leading indicator.
Okay, so we have stocks setting records, but employment signals, consumer confidence, future manufacturing orders, they're all flashing yellow or even red. This feels like the perfect moment to explain that K-shaped economy idea for the listener.
Yes, absolutely, because it perfectly rationalizes this contradiction we're seeing.
How does it work?
Well, the K-shaped economy, it basically explains why the S&P 500 can be so strong while general confidence feels soft. If you look at the up arm of the K, right, going upwards, that represents the wealthiest consumers, the ones who are heavily invested in the stock market, whose portfolios are doing really well right now. They continue to spend, they drive luxury consumption, and that reinforces those strong corporate earnings reports we talked about earlier.
Okay, so the top part is doing fine, great even. But the down arm of the K, that's where the problem lies.
Precisely. That reflects lower income consumers, people facing persistent inflation, rising borrowing costs, and now these signs of job weakness we just discussed, they are cutting back significantly.
I see.
It's really a tale of two very different economic realities unfolding at the same time.
And this uneven reality, this K-shape, it puts maximum pressure back on the Federal Reserve. We're waiting on the minutes from their last FOMC meeting this Wednesday, right?
Yes, investors will be poring over those, eager to see the internal dialogue between members, particularly the newest member, Stephen Miran. See where the debate is.
But the real headline shift, it seems, is what investors expect the Fed to do next. That's changed dramatically.
Oh, absolutely dramatic. Investor expectations for a full 50 basis point reduction in rates by the end of the year. That probability shifted significantly.
How much?
It rose from about a 68% probability just last week to an astounding 83% probability this week.
Wow. 83% chance of 50 points of cuts by year end.
Yeah. That signals the market really believes the soft data that ADP report, the ISM new orders dropping, will force the Fed's hand to ease policy much sooner and maybe more aggressively than previously thought.
Okay, shifting gears slightly. It wasn't just the U.S. markets enjoying the ride last week, was it? Global markets were also strong, suggesting maybe some underlying global momentum is helping out here too.
Absolutely, that's a great point. Developed market stocks and emerging market stocks both saw really significant gains, up 2.5% each. They actually outperformed U.S. stocks for the week.
Okay.
And developed market stocks actually closed at a record high today as well. Japan was a massive standout globally.
Japan, how'd they do?
Gained 6.4% for the week, hit a record high. And unbelievably, Japan was up 4.75% just today alone.
Wow, 4.75% in one day.
Yeah, so global growth, or at least optimism about it, is definitely feeding into that general investor sentiment.
We see that global strength, okay, but let's be honest, back in the U.S., the AI story is still probably the biggest narrative driving those indexes right now.
Oh, for sure. It's huge.
We saw AMD, for example, have a massive gain. What was it, 25.9% last week?
Yeah, nearly 26%. Huge move.
And that was fueled by a major deal with OpenAI, right, to develop specialized AI infrastructure. People talking about potentially tens of billions in new revenue.
Exactly. And AMD's performance really highlights that this is far more than just, a single stock phenomenon like NVIDIA, which gets most of the press.
Right.
If you look year to date, NVIDIA's performance through today, while impressive at 38.2%, actually ranked only ninth among the 18 stocks in the S&P 500 Semiconductor Sub-Industry Index.
Only ninth, okay.
Yeah. The entire sub-industry as a whole group is up 40% year to date. That just dramatically outperforms the S&P 500's overall gain of about 15.3%.
40% for the whole semiconductor group. That's incredible. What stands out to you in that sub-industry? Are there any, really extreme outliers driving that?
Oh, yeah. There are two truly extreme outliers that just show how much capital is flooding into the foundational infrastructure of AI, Micron and Lam Research.
And how are they doing?
Both up over 100% year to date.
Over 100%.
Yep. So this isn't just a handful of winners. This is a massive industry-wide foundational shift that is just attracting enormous amounts of capital, regardless of whether the government is open or closed.
Okay, we've covered stocks, bonds, the economic data fog. But what about the ultimate safe haven assets? What story are commodities or sort of insurance assets telling us about market fear right now?
Yeah, this is maybe the most interesting contradiction of all, actually. Gold, right, the classic safe haven, it hit a record high, past $3,900 an ounce for the first time ever.
$3,900 gold. Wow.
Yeah.
How's it doing year to date?
It's up an impressive 51% year to date. That level of performance, it suggests some serious geopolitical or maybe monetary instability concerns are definitely lingering under the surface.
51% is huge for gold. But you mentioned earlier it isn't even leading the pack in the commodity space. That sounds wild.
It is wild. That's right. If we compare the 2025 performance metric across assets, silver is actually up 68% year to date.
Okay, silver beating gold.
Then platinum. Platinum is the biggest gainer of almost anything we track, up 80% year to date.
80% for platinum. Consider that. Platinum is outperforming the S&P 500, the NASDAQ, even that high-flying semiconductor sub-industry we just talked about, and by a massive margin.
Massive margin. It's pretty incredible.
So what do we make of these metals performing so strongly while stocks are also setting records? It seems contradictory again.
It highlights the dual role they play, I think. Gold, silver, and especially platinum right now, they're acting as the ultimate insurance assets. The market seems to be simultaneously betting on robust growth, which is driving stocks, especially AI, and hedging heavily against two specific major risks.
Okay, what are those risks?
First, that the Federal Reserve gets inflation wrong, maybe waits too long. Or, second, that the political instability from the government shutdown and this deep congressional impasse actually causes unusual, long-lasting chaos that really does dent the economy significantly.
So the metal surge is the market's massive what-if hedge against those two possibilities.
Exactly. It's the insurance policy kicking in, just in case.
Okay, so wrapping this up, what does this all mean for you, the listener, trying to make sense of this? We've seen the market's pretty incredible ability to compartmentalize political risks, like this shutdown, while still celebrating economic positives, like the really strong AI sector. Yet underneath the hood, that uneven K-shaped economy clearly persists, and fear is showing up, just maybe in usual places like platinum and silver.
Right. What does it really imply about where we might be heading?